Class, I'm going to go over our narrow range patterns and how powerful they are at predicting big moves. You never know the direction the big move will happen, but usually the big move does occur within a few hours. And sometimes there's a false breakout and then the real move is in the opposite direction. And other times, like you can see here in the euro dollar, the breakout takes off and then just continues and continues. You can see this one went up 110 pips or so. Narrow range patterns basically show low volatility. And low volatility patterns tend to predict, like I said, big trends. The market goes from high volatility to low to high to low. And, volatility patterns are easier to predict than directional patterns. It's easier to predict that there's likely to be high volatility than there is to predict that the market's either going to go up or down. But using our tools, the directional part is pretty much taken care of. For example, if the price is above the hourly, which you can see here, our containment bands are made up of the outer bands and also the hourly moving average right here in gray. When price is above the hourly, it's much more likely to go up, and you can see it did. You want to take breakouts only to the upside when the price is above the hourly. So in other words, if price was going sideways up here and it broke down underneath the narrow range pattern low, the lower yellow bar, you would not sell because the price is above the hourly, and it's not likely to go down that much. It might go down 5 or 10 pips or even all the way down to the hourly and then reverse back up. Whereas if you find a pattern like this, and they're always better when they're in the middle of the range, because the upper containment bands is usually most days where the market goes and stalls. So you have about 3,200 as the likely profit target, and you're in this trade at 56, you have 44 pips to profit from. In aggressive traders, whenever you see two narrow range patterns in a row, they're very likely to have big moves. You rarely will get two narrow range patterns in a row, and you might have even jumped the gun and got into this when it broke out right here at 44 versus 54. You're in at 10 pips earlier. You can see your stop is ridiculously tiny in this case, and you'd be out. You can either get into these trades and when there's a pullback, put your stop underneath the low. When every time it makes a higher high and pulls back, you move your stop up. Higher high and pulls back, you move your stop up. Higher high and pulls back, you move your stop up. And you would have been stopped out right here at around 40 with an absolutely huge 80 pip profit. Let's look at some of the other ones. Today was a huge day for narrow range patterns. Here's an example of one that failed. The price was above the hourly. However, it was just kind of sitting on the hourly, which sometimes happens. And when it breaks down underneath here, technically you're allowed to sell that. But keep in mind that the price was above the hourly, and it's a little bit less likely to really result in a trend. However, the weekly and monthly trend were down. So you go short right here, and guess what? You have a loss. If that happens, you want to wait for the low to get broken before you go short again. And as it's going sideways and breaks out here, you want to go long because it's back above the hourly, and you're anticipating it breaking out the high. Anytime you have a false breakout of one of these patterns, usually it goes the opposite direction. And because the price was above the hourly, this is just a false breakout to the downside. It's much more likely to go up. Here is a narrow range pattern. This one's not quite as good as the first euro dollar one because price is already near the upper containment band. Therefore, when you buy this breakout right here, your potential profit target is right here at the previous week's low in the upper containment band. It's not as far away as the other one. You buy this breakout here, and you can see you pretty much got this trade at a break even. It kind of went sideways again. You go long again right here, and then you draw your fibs on that wave, and you can see it went right to that level, which is also the weekly low. You're out of that trade. The second one in at 02 out at 20, you made 18 pips. You might have lost 5 or 6 on the second one because you bought here, the market went up, came down, stopped you out pretty much near break even. You only lost the spread. These oftentimes, like I said, lead to big moves. So when the market's up near the highs and it goes sideways, when it goes up again, you get in right here at 24. And if you got out at the trailing stop right here, you'd be out at 55. Most of us would have drew our fibs on here and really look to get out near the 1.618. In my experience, 70 to 85% of the time, the 1.618 fib target, especially when it's above our upper white containment band, is the end of the move. So I would have personally got out of half my trade here and the other half here of my average exit here at 66 versus a trailing stop at 54. Caught a little bit more pips. And that allows you to buy the next move. And you can see that one also was a huge 50 pip move. So it only takes one nice trade like this to get rid of a lot of losing trades. One nice 50 pip win can get rid of 5 to 12 losing trades. Just one win. Pound yen, narrow range pattern. This one is nice because it broke out from below to above the previous day's high, and it's just going sideways right here. So when it breaks out, again, the upper containment band, good place to get out of half your trade, and then the rest here, it goes sideways without pulling back. You get in again, and you can see it went up, 70 or 80 pips. Big trends happen after these patterns, and there's a lot of them today. Here we go again, two narrow range patterns. Again, two narrow range patterns have a much higher winning percentage, and they also lead to bigger trends. I would, really kind of bet the farm on these type of trades, especially when the price is underneath the hourly. It breaks out. Previous day's low is a potential profit target. It goes underneath there and goes sideways. You have your trade somewhere around 49. You don't make that much on that trade. Comes back up, finds resistance. You go short. You have a small profit. You go short right here, a loss. Short again, pretty much break even. Short again, and that trade, falls about 30 pips. Once it goes underneath the lower containment band, it's up to you whether you want to take the trade. If it's within 15 pips of the lower containment band, the white band, usually I'll pull the trigger. In this case, the weekly trend and monthly trend are up. So I would watch that like a hawk. Any sign of this area or this area acting as support, you're out of your trade. Here's a narrow range pattern. And you can see in this case it failed. Broke out. Again, it's near the lower containment band. So this is one of the reasons why the lower containment band is so valuable. If you take a trade right here and it goes down, in this case to the 10-day moving average, lower containment band starts going up, at least you have a chance to get out of this trade at break even. And at that point, you really, most of the time, want to wait for it to break this low before you go short again. You might not have been able to. It looks like it's a news event here that caused that move. You might have missed it. And then on the pullback, you go short, maybe made 7 or 8 pips. It's the least profitable of all of the trades. Again, this is another good example of, when a narrow range pattern is right near the upper containment band, and if there's any other resistance right there, it's usually a lower odds trade. I mean, it went up, came right back down. It's kind of chopping around here before it finally went up. It wasn't as smooth of a trend as some of the other ones. Australian yen, narrow range pattern was in the middle of the range, so it had good amount of pips to go. That's always a preferable choice. And then later on it came back down and found support at the 20-day moving average, previous week's low. You might have bought here and here for another 25 pip on each of those trades. And lastly, the New Zealand yen, also in the middle of the range, which is always good. Breaks out to the top. Unfortunately, the next resistance area here is 55. So it's up to you whether you want to take a trade that has a 15 pip profit target. But I would have got out of half my trade here, then got stopped out with maybe half the profit on the second half. Bought the next one here at a small profit. And it's really debatable whether I would have bought that next breakout here because the weekly trend is pretty strongly down.